Hello students, today we are going to discuss on the various methods of risk classification. Yesterday in the class I told you that there are basically two methods. One is judgment method and another one is numerical rating scale system. So as the name itself speaks, judgment method is a judgment or an opinion based method where the people belonging to different lines of activities like in medical or in underwriting, they study the cases or on the basis of the material information that is supplied by the insured to the insurance company, decisions are taken whether it is a critical case or it is a regular case. Because people when they provide information, they that can be of different types. For example, a person may be suffering from a special kind of disease, or maybe a person is doing a very risky job, maybe in a factory or in an industry where life is exposed to more risk. So this kind of decisions are taken by the experts in the medical line or in the underwriting, that whether this risk should be accepted or rejected. And under judgment method, remember that those cases which are very critical, they are handled by the experts, and those which are routine cases, these are handled by the assistants or by the the staff who have just joined the organization, who do not have that much of experience. This method is not considered to be very scientific because no rigid rules or regulations are followed while accepting or rejecting a particular risk. It is completely opinion and judgment based. So this one of the serious limitation of this method is that it may suffer from the negligence or the carelessness of the people in this line of business or activity. The another one is numerical rating scale system, and under this system it is more scientific because the family health history as well as personal health history of the insured is studied, along with some other kind of demographic profile or information is collected, like the health or the food habits or the weight of the person. Because for example, overweight is not considered to be good, and many kind of diseases may be associated with overweight or with the obesity of a particular individual. So if a person is found to be very obese, then that kind of life is considered to be more risky for accepting the risk. Again, there is one concept of substandard risk. Now, what is substandard life? Substandard life is that life where it is perceived that they have the probability, or they are more prone to risk factor. Before accepting or rejecting a particular person insured, the insurance company, they asked for some kind of test. It can be a blood test, or it can be any kind of test, maybe related to ECG for heart, or it can be related to liver, it can be related to kidneys. And when the risk results are positive, that means the person is free from any kind of diseases. These are called favorable factors, and these favorable factors are assigned negative points, which are called credits. Okay, I have given that in the in the discussion yesterday in the class. You just check out. And the unfavorable factors, that means whenever the test result shows that a person is suffering from some kind of disease, then these are called unfavorable factors, and they are allotted negative points that are called debits. So a standard life, it is a standard risk is considered to be somewhat of 100 points. So more point a person will get, that means more debits they will be getting. That means that life is considered to be more prone to risk, and less points means the life is free from risk, or less risk is assumed. So better is that more points means more premium, and less points means less premium. Okay. And one more thing I want to tell you, so a particular percentage to be added or deducted for each factor will depend upon the degree of its variation from the situation which is considered for the normal risk. You remember that. Okay. Another one is risk retention and risk transfer. So risk retention is what, when some companies, they feel that it is better to assume the risk, it is better to face the risk rather than to transfer it to another party through insurance. Now, when it happens, when the company feels that it becomes less costly to accept the risk, to face the risk, rather than to finance it or to give it to an insurance company. Because small kind of risk, sometimes company, what they do, that every year they stock or they keep a reserve fund for facing some kind of uncertainties or crisis that may happen in future. So that is a part of their profit. They keep it as a reserve fund, and they utilize it for meeting any kind of contingencies that may arise in the future, to to face any kind of risk. So that is, the fund is created for risk retention purpose. and for small kind of risk it is done, and for bigger risk they always go for transferring it to another party. So this is risk retention. And when we assume the risk by creating our own reserve fund by a company, it is called self-insurance. Remember, this is called self-insurance, and another part of it is called captive insurance. So captive insurance is what it is. It is like an entity, or it is like a firm where which is owned by a parent, whose main purpose is to provide insurance to the corporate owners. And why they go for captive insurance? Because they feel that some kind of commercial insurance companies, they do not cover all kind of risk which are covered by the captives, and they also give at more competitive prices as compared to other insurance companies. Again, captives are of two types. One is pure captive, one is group captives. So pure captives is where the person who has the parent, that person is the captive also, and that person is the beneficiary also. But in case of group captives, it is opened by a parent company, but where it allows other companies also to be in the captive by paying a rent. These are called group captives. Okay, one is risk transfer. Risk transfer is where some companies feel that no, it is not wise, or it will be too much of risk to assume all risk. So what they do, they transfer a part of the risk to another party, to third party. That means they outsource the risk to other party. And how they do it? They do it through insurance. Okay, so to remember, when we speak of risk transfer, then risk transfer is done. That means the risk is outsourced to another party. How? Through insurance. And when the risk is retained, it is called self-insurance. So one is self-insurance, and another alternative is captive insurance. Okay students, so just go through it. Whatever book you follow, in all the books you will find these things. So in the next class we will be discussing about the measurement of risk. Okay, till then all of you take care, stay safe, stay indoors. Bye bye.